In today's episode, I'll talk about two stories. In the first one, I'll talk about why India's biggest IT companies are currently struggling despite them having record deal wins and how AI, tariffs, and client cutbacks are sort of changing the space quite a bit. In the second story of the day, I'll talk about why the IMF or the International Monetary Fund cannot really predict the global economy anymore and how global trade wars are making everything around us very uncertain. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 24th of April. Let's begin with the first story. See, Indian IT companies currently are going through a very difficult time. And this is not a rumor or a media exaggeration, mind you. It is straight from the companies themselves. See, in their latest earnings calls, giants like Infosys, Wipro, and TCS have given us directly or indirectly a very clear and a very sobering picture. And the picture is that growth is slowing, deals are becoming delayed, and clients are sort of cutting back. And the reasons behind the slowdown are far more layered than just a few bad quarter of results. But in order to understand the lengths and depths of what's exactly going on, let's first understand by looking at the numbers. See, Infosys, which is one of India's biggest IT companies, has said that it expects to grow by just 0 to 3% in FY 2026.
Our guidance for growth in financial year 2026 is 0% to 3% in constant currency terms. The environment is uncertain, and we will execute our plans with agility while keeping a close watch on changes.
Now, of course, that is very, very low, especially when you consider that analysts were expecting them to grow by more than twice that amount, which is around 6.3%. And this is not an Infosys only problem, mind you. Wipro has also issued one of its weakest outlooks ever, only excluding the COVID-19 period. And while TCS, which is another market leader, has missed its earnings expectations, the story is expected to be very similar there as well. So basically, this seems to be an industry-wide problem and not a one-off scenario. And the stock market has picked up on this concern as well. While India's broader Nifty 100 index has given almost flat returns this year, the IT sector index has fallen by nearly 20%. And that is a huge drop, especially for a sector that was once seen as India's most reliable export story. Now, some of you who are early watchers and listeners of the show may remember that we had spoken about a few early warning signs last month. Now, at that point in time, the concerns were mainly about a weakening US dollar and a possible return of Donald Trump to the White House, both of which at that point in time could lead to high inflation, slower economic growth, and tighter interest rates in the US. And basically, since the US accounts for about 60 to 62% of the Indian IT sector's revenue, any sort of trouble in the US economy sort of tends to reflect very quickly on Indian IT exports. But ever since then, things have gotten even more complicated. Trump, of course, is back in the office, and he has announced reciprocal tariffs, which are essentially new taxes on foreign goods that are coming into the US. Now, these new tariffs are not directly aimed at software or IT services, so technically Indian IT exports should not be affected. But the problem is that the reality is a lot more nuanced. You see, the real problem is what happens to the clients of these Indian IT firms. Many of their biggest customers are American companies who are into manufacturing, retail, logistics, or consumer sectors, all of which sort of heavily rely on imports. And these new tariffs basically make their imported goods a lot more expensive. And obviously, when costs go up, these companies tend to tighten up their budgets. And that in turn, of course, means that they tend to spend lesser on things like tech upgrades or new IT projects, which in turn directly affects companies like Wipro, Infosys, and TCS. And it's not even a slowdown in some cases. Some clients are pressing pause on tech projects altogether, and some others are stretching out their decision cycles, which is leading to delays in deal signings. Many people are also avoiding discretionary projects altogether, which is the kind that are not urgent but sort of nice to have in some sense. To give you an instance, Wipro reported that discretionary tech spending dropped by 13.4% in FY 2025. So what we're seeing right now is a very clear shift, which is that projects which are focused on cost cutting and efficiency are still going ahead, but innovation-led or experimental tech projects are getting shelved. There is another angle to this as well, and that one is a little bit more hidden in comparison. See, over the last few years, Indian IT firms have signed massive multi-year contracts with global clients. In theory, those deals should keep them going even during bad times. And on paper, they are sitting on record wins for sure. TCS, for example, had a total contract value or TCV of $12.2 billion in quarter 4, which is its highest ever. But the catch here here is that the clients are now starting to pull back even after signing these deals. Projects are being delayed, and in some cases, they are quietly being cancelled as well. And that is what some brokerages are calling as leakage, which is where the value of the contract does not fully translate into revenue because the execution stalls or does not happen at all. But that said, not all sectors are equally affected here. Clients that are into banking and financial services or BFSI are holding up a little bit better than the others. And that is because their business is not directly affected by import tariffs, unlike places like manufacturing or retail. So basically, IT companies which have relatively more exposure to BFSI clients may still see some level of stability, but overall, it is still a very shaky and a wavy environment. It is also worth noting that the IT sector, despite everything, is still in better shape than many other export-driven sectors. According to the World Trade Organization or WTO, the global demand for digitally delivered services, which also includes IT services by the way, is still expected to grow, but just at a slower pace than earlier projected. The growth rate for 2025 has been revised to 5.6%, down from 6.6%. So while things are definitely rough, they are not entirely bleak, to be honest. But the problem when it comes to IT firms is that this particular downturn that I'm talking about is hitting at the same time as one more major shift, which is the rise of artificial intelligence. See, AI, as all of us at this point in time I'm sure know, is changing the rules of the game for IT companies in many ways. Things like generative AI are helping companies write code faster, automate testing, and even deliver projects with fewer people. Cognizant, for example, says that 20% of their code is now being generated with AI assistance. And that means that companies are becoming much more efficient than they ever were. And while that is great news in some sense, there is also another angle to this. Clients are noticing that as well, and they are now asking these IT companies for discounts. They are basically demanding lower prices for the same work, and they are arguing that if AI is doing a part of their job, they should not be charged the same amount of money as they were charged earlier. And this suddenly creates a very new kind of challenge for IT companies that they had not really faced earlier. See, while their operating costs might drop due to AI, which is a great sign, the problem is that clients also pay them lesser money, so their revenue growth could still suffer net-net. And while their profit margins may stay steady of sorts, unless they expand their scope of work or maybe offer new services, their top line could sort of start to flatten out. But on the positive side of this, AI also creates a lot new opportunities. New companies that will survive this phase are likely to be the ones that shift away from basic services and towards productized platforms, intellectual property-based offerings, or consulting-heavy models. So in other words, as things stand today, it looks like those companies that evolve from just being outsourcing partners to actually tech advisors will actually end up winning this race. It is almost like a two-way road at this point in time. Do you stay like a services body shop model, or do you reinvent yourself as a knowledge-driven partner of sorts? But meanwhile, the biggest pain right now as we speak is being felt by employees and job seekers. See, hiring in this sector has slowed down to quite a bit. Companies are cutting back on new additions, they are delaying wage hikes, and are also increasing internal benchmarks. Infosys, for example, onboarded only 15,000 freshers in FY 2025, which is a very big fall from their previous hiring years. And they plan to hire just 20,000 people in FY 2026 as well, which is still very low as compared to their past trends. They even let go of more than 500 trainees this year, and they cited failure to meet internal assessments. Now, these of course are not exactly layoffs due to business collapse, but it signals how cautious the environment has become as a whole. And when it comes to Wipro, they added only 614 employees in the last quarter, and TCS added about 625. Now, these of course are very tiny numbers for companies of this scale and size. And at the same time, utilization rates, which basically show how much of the workforce is actively being used on billable projects, are going up. Wipro's utilization, for instance, is now 84.6%, and that is very high by their standards. And this means that companies are now making do with fewer people, and they are pushing their teams much harder, and they are sort of extracting more from the current bench strength that they already have. And while this may be a great sign from the company's perspective, the downside to this is that there is very little slack left to quickly take on new projects if demand bounces back quickly. In many companies, wage hikes have also been postponed. For example, TCS delayed its usual annual raises, and that tells you that even the biggest players are in cost control mode right now. Growth is sort of no longer their priority in some sense. Instead, efficiency is. And in many ways, all of these companies are now trying to cut off their inefficiencies, build resilience, and weather this slowdown without having to slash headcount across the board. On that note, let's move on and talk about the second story. See, the International Monetary Fund, or the IMF, recently put out its World Economic Outlook, and it's created quite a few conversations on the internet. See, one of the biggest headlines to come out of it was that India's growth forecast for 2025 has been cut to 6.2%. Just a few months ago, for your context, the same IMF had projected 6.5%. And I know while this 0.3% drop seems like a very small number on paper, the thing is that in the world of economic forecasting, this number is very meaningful. And it's not just in India, by the way. The forecast was trimmed for many countries across the world. But to understand why, let's first take a quick step back and understand where the global economy currently stands. See, through most part of 2024, things were looking fairly stable. Inflation had been a big worry post-COVID, but it had started to ease out by then. Labor markets were getting back on their feet, people were getting jobs, wages were stabilizing, and overall growth sort of hovered around 3%. Now, of course, that number is not great, but it's also not disastrous, right? Economists basically call this a phase of potential output, where an economy is more or less operating at its full capacity, is not too hot, but not too cold either. But the problem is that this sense of calm did not really last too long. Towards the end of the year, everything started to shift quite rapidly. And a big spark for all of this was the trade tariffs. When the US started imposing tariffs on other countries responded with their own counter tariffs, and it sort of quickly turned into a game of tit for tat of sorts. And the result was a very sudden, sharp rise in uncertainty across the world. Stock markets started to fall, bond yields started to spike, and businesses started to worry. There were all sorts of questions and confusions. Things like, what will trade look like 6 months from now? What will the rules be? Will your supply chain still function smoothly? And so on and so forth. And uncertainty basically was the heart of this entire problem. And it's not just economists who are saying this. The World Trade Organization, which is a global body that oversees international trade, has also admitted that it has no clear view of how the world economy might move ahead from here. And now the IMF is saying the same thing as well. Now, for your context, normally the IMF gives a neat projection of how the world economy will grow over the next few years. They basically use a baseline scenario, which is basically a stable central assumption about how policies, prices, and global trade will evolve. But this time, the world has become too chaotic to even come up with that kind of a baseline. So instead, the IMF has done something a little bit different this time around. They have issued what they are calling a reference forecast. Now, this forecast is frozen in time and is built using data from 4th April 2025, which is just 2 days after the US announced its latest set of tariffs. Now, this is not a stable projection of the future. It is more like a snapshot, which is a model of the world at one confusing, uncertain moment. Now, you might ask me why this is such a big deal. See, that is because forecasting is already tough in normal times. But when policies are changing every single week, sometimes even within the same day, no model can sort of confidently predict anything at all. There was even a day, by the way, when US tariffs on Canadian steel and aluminium were introduced in the morning and they were rolled back by the evening itself. One economist even jokingly called it the first ever intraday tariff chart. So given all of this chaos, the IMF has sort of dropped the idea of one clean prediction now. Instead, it is offering a range of scenarios, one where things worsen, another where they improve, and a reference version based on April 4th. But that said, despite all of this uncertainty, the IMF still has to try and make sense of where we are headed, right? Now, based on what they can tell right now, global growth will slow down from 3.3% in 2024 to 2.8% in 2025. And that, mind you, is a very significant drop. And even in 2026, growth, while is expected to pick up, is only expected to go to 3%. And that, mind you, is still well below the pre-COVID average of 3.7%. And the core reason for this downgrade is the same one that has been shaking up the markets, which is America's trade policy. The new tariffs and the uncertainty around them are making companies hold back. Businesses do not know what the rules of global trade will be tomorrow, so they are basically playing it very, very safe. And that, of course, hurts investments. Consumers start feeling anxious, factory outputs drop, people get laid off, hiring slows down, and very slowly as a result, economies start cooling down. But while America's policy chaos is a major reason for the slowdown, it is not the only one, mind you. Take China, for example. Even before this trade war, China was facing problems. For many years, its economy had been heavily dependent on real estate. But that bubble burst and builders went bankrupt. Local governments ran out of money, people stopped spending, and confidence dropped overall. And if you add US tariffs to that entire mess, things got even worse. But still, China is still the world's largest manufacturing hub, and any hit to its exports sort of has ripple effects across its economy, right from factory jobs to household incomes. Other parts of the world have their own troubles as well. In the US, consumer spending, which had boomed post-COVID, is slowing down. Europe is struggling with high energy prices, which has made manufacturing more expensive and less competitive. Inequality has risen in many countries, and middle-class families are feeling the squeeze from rising rents to unaffordable homes. So in just a few months, so to speak, the world economy has gone from cautiously optimistic to deeply unsettled of sorts. But that said, not all countries are being affected equally. The United States is expected to see a sharp fall in its growth rate from 2.8% in 2024 to 1.8% in 2025. And that is a huge drop for such a large economy. Apart from the confusion created by trade policies, one more reason is that the US economy was overheating in 2024, which means it was growing faster than what economists believe was sustainable. But now it is starting to cool off as well. Europe's picture is even bleaker over here. The Eurozone is barely growing, with the IMF forecasting just 0.8% growth for 2025. Germany, which is usually Europe's industrial engine, is also struggling with high energy costs and trade disruptions. Spain, on the other hand, is surprisingly doing a little better due to recovery work after floods and a pickup in services, but the overall mood remains largely weak, to be honest. And if we come to Asia, Japan is dealing with a stagnating economy and it is expected to grow at just 0.6%. US tariffs on autos and electronics are hurting it quite badly, even though a weaker yen had briefly helped exports. And wages are rising, which is good, but uncertainty is holding people back from spending. China's growth is projected at 4%, which is down from stronger numbers last year. And as I mentioned earlier, its problems are deep and structural, from real estate troubles to falling consumer confidence and deflation in some sectors as well. US tariffs are basically just adding to all of this stress. Now, coming to India, interestingly, we stand out as one of the most stable economies. The forecast might have been cut from 6.5% to 6.2%, but we are still the fastest growing large economy in the entire world. And most of that growth, by the way, is coming from domestic demand, which is a great sign. Exports are slowing, but Indians are still spending, which is helping our economy hold up. But even for India, this global trade war has consequences. The IMF warns that this is not just a growth issue, it is also an inflation problem. Tariff raises prices, and that is the basic idea. If you put a tax on imported goods, they become more expensive, right? And that feeds into inflation at the end of the day. But there is still a second order effect to that. When trade becomes unpredictable, businesses are less willing to invest in global supply chains, and therefore costs go up, currency markets become volatile, and that volatility makes imported goods even more expensive. So while many countries are trying to fight inflation, these trade tensions could sort of undo all of that progress. And ironically, the US, which is the country that started the tariff wave, is now expected to see one of the biggest increases in inflation. But with all of this said and done, let's also understand that any of us here could be wrong, and even the IMF admits that it could be wrong here. There are several risks that could make things worse. For example, the forecast assumes that things will not escalate any much further. But what if they do? What if China and US go deeper into a trade war than what they currently are? Or what if financial markets crack under pressure? See, currently stock prices are still holding up fairly okay. But if investors suddenly start to panic, prices could really fall sharply, and bond yields, which are already very high, could go even higher. And this could make debt expensive and slow down growth even further. There is also a fear that the kind of inflation that we saw during COVID could even return back. Back then, central banks stepped in with massive support, but the thing is that they've already used many of their tools. They don't have as much ammunition of sorts left this time around. Poorer countries are at an even greater risk. Many of them are already struggling with high debt and rising interest rates. And if borrowing costs keep rising, some of them might tip into a full-blown debt crisis with social unrest to follow it. And then there are longer-term problems like aging populations and falling productivity in many parts of the world. These structural issues are much harder to fix, and they make future growth even more difficult. Now, the question, of course, is what can be done? See, the IMF says that there is still hope. If countries can de-escalate the trade war, bring back predictability, and sign long-term agreements, that would be a good start. Predictable rules are much more valuable than zero tariffs right now. And they also say that this moment of crisis could be a great opportunity. Countries that use the slowdown to make smart domestic reforms, fix fix labor markets, invest in infrastructure, or improve governance could sort of bounce back much stronger. Central banks also have a big role to play. Basically, if they can guide inflation down slowly and carefully without really crashing demand, it could ease some of the pressure. And if exchange rates go haywire, they may need to step in and restore balance over here. And maybe if countries coordinate on trade rules, debt relief, or currency stability, we might just see the return of some level of order. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Bharti Airtel has announced the acquisition of 400 MHz spectrum in the 26 GHz band from Adani Data Networks Limited, which is a subsidiary of Adani Enterprises. The spectrum, which was originally purchased by ADNL for 212 crore rupees during the 2022 5G auction, was intended for the creation of private 5G networks, but it remained unused. Second, the Reserve Bank of India reported a dip in the rupee's real effective exchange rate to 101.49 in March, down from 102.37 in the month of February, continuing its slide from 108.14 in November 2023. Third and the final one for the day, electric two-wheeler maker Ather Energy has set its IPO price 304 to 321 rupees per share, targeting a valuation of 1.4 billion US dollars, which is 44% lower than previously expected. The IPO, amounting to approximately 350 million US dollars, will open for bidding from 28th April to 30th April, with anchor investor participation beginning April 25th. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.